Companies make 2 payroll-related journal entries every pay period. You will need to know how to make these journal entries, and you'll also need to know which taxes go into which entry. So on the bottom half of this sheet, you see the 2 payroll journal entries. The first one records the payroll. This means recording all the employees' gross pay and all of their withholdings. The second payroll entry records the company's share of payroll-related taxes. The 2 lists at the top of the sheet show you which taxes go into which entry. You will not need to memorize any tax rates. You'll be given this information in homework problems and also if you need them on the next test. I have a couple of rates in here which you will be using in homework problems, but again, those will always be given to you in the homework. So let's take a closer look at the 2 journal entries. In the first entry, to record the payroll, the debit to salaries expense, or wages expense, represents the full gross pay of all employees combined. So if you have 100 employees on your payroll, this will be the gross pay for all 100. The credits are all of the withholdings from the workers' paychecks. Now FICA, which is Social Security and Medicare, has a limit to it. And our authors are assuming 8% of the first $100,000. That's not exactly right today. In fact, that changes every January 1st. But what this means anyway is that since there is a limit for each person, if you have someone who earns during any calendar year $100,000 or less, then all of the gross pay of that person will be subject to the FICA rate. However, if a person earns more than $100,000 in a year, then the excess dollars over $100,000 are FICA free. There's no tax. So if a person earned $1 million a year, only the first $100,000 would be subject to the Social Security and Medicare tax. So this is definitely a tax that hits the lower income people significantly harder than upper income people. Now we also see federal income tax, state income tax, and local income tax. Everyone pays into the federal income tax, but state and local are withholdings that depend on where the person lives and works. So some states do not have a state income tax. They might get their tax revenues through other sources like sales tax or property tax. And many local governments, different cities, they may or may not charge a local income tax. So in our area, Saginaw has a city income tax, but Bay City and Midland do not. Okay, so when you're doing homework in the book, don't be alarmed if they do not give you a state income tax or local income tax. Just assume that you're living in a state then that doesn't have a state tax, and you must be living in a small community. Now you might also have voluntary withholdings, and I just plugged into here an example, United Way payable. But the biggest voluntary withholdings are actually where workers voluntarily want to contribute to their retirement fund, like a 401k plan, for example, or also contributing to hospitalization, medical insurance premiums. Those are the biggest voluntary withholdings. One thing that all the voluntary withholdings have in common is that the employee has to actually authorize in writing for the company to withhold those voluntary withholdings. Otherwise, the company can't do it. But for the taxes, those will be withheld if they apply, whether the worker wants them withheld or not. Okay, so we've got the gross pay being debited to salaries expense. The withholdings are all these credits, and there's one final credit here to salaries payable representing the net pay or the take-home pay. That's what's left after all the withholdings have been subtracted out. And finally, notice that all of these credits end in the word payable. They're all liabilities. The withholdings are all liabilities because the company withholds that money from the worker's paycheck, but then the company sits on it until it's time to turn around and remit it to the various taxing agency. So while the company is holding on to it, it's a liability on the company's books. And finally, down here in the bottom entry, the debit to payroll tax expense is simply the sum of the 3 taxes that the company has to pay related to its payroll. The first one is Social Security and Medicare, and it represents a matching amount. So with whatever was withheld from the workers' paychecks in the first journal entry for FICA, the company has to dig into its pocket and chip in an equal matching amount. The company also is responsible for paying into the 2 unemployment funds, federal and state. The rates we're going to be using for our book are 0.8% of the first $7,000 for the federal fund, and that would be the first $7,000 that each employee earns. Now again, this is not coming out of the employee's paychecks. The company has to keep track of each person's cumulative pay, and as soon as a person goes over $7,000 in any given year, the company no longer has to pay into the unemployment fund for that person. The state rate is 5.4%, again, of the first $7,000 that each person earns. I'd encourage you to read more about these payroll taxes and all of the withholdings in Appendix F at the back of the book. That's not at the back of Chapter 10, but at the back of the book. And if you have any questions or any interest related to your own paycheck, you might get some answers by looking at Appendix F. But if you know this sheet here, this should pretty much summarize the main things that you need to know about payroll.